Let's see an example here. Well, we've got Faro Company. They're applying for a loan in which the bank requires a quick ratio of at least 1. Their quick ratio is 0.8. How would the company improve their quick ratio? A quick ratio is better when it's higher. The ratio is right here. So I definitely, again, recommend memorizing all of these ratios and formulas. The bank wants you to have a higher quick ratio because that's better for liquidity, making sure that you have cash and other current assets on hand to pay down debts. A higher one is better because, right, cash assets are good. Liability, in my brute, simple, gross oversimplification of it, current liabilities are bad. You want to have more good on top, less bad on the bottom. Now we see here the solution to this, and there would be other options if you were seeing this in a multiple choice question. However, the solution here is by selling obsolete inventory at a loss. Why would that help? Let's think about that for a second. Well, we don't see inventory counted in the quick ratio. So if we sell obsolete or any inventory, now it doesn't have to be at a loss, it could be at a gain, just selling inventory in general and turning that into cash, that's not going to have any effect other than increasing cash. Because what are we going to do? We are going to debit cash and credit inventory. We are going to increase cash, and there's no effect of inventory anywhere else here. So by selling any inventory, whether it's obsolete or regular, at a loss or a gain, they would increase their quick ratio, also known as the acid test ratio. This measures the number of times that cash and assets that can be converted quickly to cash can cover current liabilities. If you want a higher one here, the process of selling this inventory would increase cash in the numerator without changing current liabilities in the denominator, which would increase the quick ratio. Situations like these are quite abundant. You want to be as familiar as possible. You could have any situation and any ratio. They issue debt. How does that affect the debt to equity ratio? Any of these are applicable, and they're all fair game. Make sure you're familiar as much as you can be. Here are our activity ratios. We saw these a little bit before. We saw how the days in sales in accounts receivable can also be referred to as the days sales outstanding. Just a reminder, memorize these, right? All of these go into the cash conversion cycle. And this is the process, again, like I said, of just making cash. You have your payables, you buy things on credit, you buy pieces of inventory, you sell them to customers, you have accounts receivable when it comes to that, and then eventually you turn that to cash. Let's see an example here. Well, we have Silverstone Inc. They have annual revenue of $50 million and cost of goods sold of 45. Now, I like to just jump to the question first. Let's see. Calculate the company's days in inventory, days in accounts receivable, and days of payable outstanding in order to calculate the cash conversion cycle, similar to what we just saw in that prior slide. Obviously, have those formulas memorized. The cash conversion cycle is representative of all of these three formulas, and this is going to be simple plugging in what we have, seeing what we got. Days in inventory, that's the average inventory divided by cost of goods sold divided by 365. The question will say, assume a 365-day year. Well, what's our average inventory amount? It is going to let us know that it's 10 million. We plug that in. Now, it could be more difficult. It could say year one's inventory was 5 million. Year two's inventory was 15 million. You average those out, add them together, divide by 2, right? Whatever that looks like, that could be a way to solve. Here, you could also, in a question on the exam, you could have to calculate these, again, compare them to a competitor, compare them to the industry, and understand, do you want a higher or a lower of these? Well, you want a lower days of payables outstanding, and you want a lower days in inventory and a lower days sales in accounts receivable and a higher days of payables outstanding, because you want this number to be as small as possible. And why do you want that to be as small as possible? Because this is how long it takes you to just generate cash. You can think of it like the cash generation form. It takes you 82.7 days to make cash, to buy inventory from vendors, to sell that inventory, and then to collect those receivables. This represents how long the inventory has to sit there before it gets off your shelves. This represents how long it takes you to collect your accounts receivable. And you see that you want these to be as short as possible. Ideally, you're not holding on to your inventory. You just get rid of it right away, right? You don't have to pay for storage fees, storage costs. You don't have to worry about insuring it. You just get rid of it. And you want this to be long because the longer you don't pay your bills, the more you can use that cash for other things like paying down other bills, investing it, growing it, even getting a simple, small interest rate at a bank. So this is just simple plug and chug. We're going to just take all of our amounts that are given in the question, plug them in, and then we get our 3 days amounts. add slash subtract depending on what they are. That gives us our final answer of 82.7 days. Again, this is something you can see on the financial exam. However, it's something you could see on quite likely many other parts. Make sure you're familiar. Make sure you not only are able to answer it mathematically, however, you understand it conceptually, what we're talking about, why it's important, and how it relates to a company. You as an auditor need to have incredibly precise and incredibly detail-oriented knowledge of all these formulas and what they mean for a company. Now, if this cash conversion cycle is just getting absolutely horrible, it's 365 days, right? It takes them 365 days to convert just their business to cash. That could be indicative of a going concern issue. There we go. See how it connects overall. Or if you expected it, right? We talk about analytical procedures. We expected this to be 60 days and now it's 82.7 days. Maybe that's a significant variance. I don't know. It would depend on your expectations as the auditor. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.